Welcome to this Killik Explains finance video. This week, why time out of the equity market can be dangerous and indeed costly. Now, we call this tin hat time. It is tempting in times of volatility to move money into cash and then try and move it back in again at what seems like the appropriate time. But I'm going to argue here that that can be dangerous. And a simple rule of thumb still applies to long-term investing. The longer you spend in the market, the more likely it is you'll make positive returns, and the greater those returns are likely to be. Now, Barclays have done a study that looks back over the last 50 years and the last 115 years and comes to a pretty stark conclusion. Whilst the past is no guarantee of future performance, anyone who's been in equities over the last 50 years could have expected to make an annual real return of just shy of 6%. Over the last 115 years, 5%. Compared to sitting in the sidelines in cash, where you're looking at an annualized return of more like 1.5% or 0.8%, depending on which period you look at. Now, that's quite a big difference. So the question then becomes, well, how can you maximize the chances that you're nearer that than that? Well, in a nutshell, it comes down to the length of time you spend invested in equities. Market timing is tough and not really advised for long-term investors. And I want to throw some charts out just to try and highlight why that is. First of all, the cost of missing the best investing days. A rule of thumb in stock markets is after they drop sharply, they often recover sharply. And as a long-term investor, if you miss those recovery days, it can really hit your returns. Two stats only here. Fidelity have estimated that the return from a global index, the MSCI World Index, between 2002 and 2012 was around 69%. If you missed the 10 best investing days, just the best 10, that drops to negative 4.5% more or less. That's a huge difference. And JP Morgan did a slightly different study but on a similar line, suggesting that the S&P 500 between 1993 and 2013 offered an annualized return of around 9.2%. Anyone who missed just the 10 best investing days ended up with around half that. So you can see just by missing those 10 best investing days, and who knows where they're going to be, incredibly difficult to predict, you can seriously damage your annual returns from different parts of the market. Now, a quick look at why that is. It's because if you miss one of those days, you not only miss the gain on that day, but you also miss the subsequent compounding effect. Just to illustrate that, taking the FCA's illustrative rates, the regulator's rates, at a rate of 2%, you would double your money in around 35 years if you're invested. At a rate of 5%, because 2 is pretty low, you'll get there in around 15 years if you stay invested. Crank that up to 8% and you'll double your money in around 9 years. But you've got to stay in the market to allow compounding to work. It's not just about missing out on that single day's gain, those top 10 days, it's also about the subsequent compounding effect you lose too. Now, just to show you that from a couple of different angles, Fidelity again have come at this from a slightly different angle and said between 1980 and 2012, what was the probability of a negative return if you stayed invested in global equities? Key is stayed invested. And this is quite interesting because basically what this shows is that there's a reasonable probability of a negative return if you're only in for 1 year. Indeed, there's a reasonable probability of a negative return if you're only in the market for 5 years. But look at what happens here. Once you get to 6, 7, 8, 9, 10 years, and once you get out to sort of 11 or 12 years, which is over here, your probability of a negative return, the way they calculate it, plummets to pretty much 0. But you have to be in the market in order to minimize that chance. And they calculate that as the number of negative annual returns divided by the total number of monthly return periods. So quite interesting. Time in the market, according to Fidelity, does pay off. Now, to go right back to 1899 and back to Barclays for a moment, they've done an interesting study which I've highlighted before. If you missed it, here it is. What they've done is to look at various periods you could have held cash, gilts and equities for since 1899. And the interesting stuff is actually kind of up here and down here. Over very short holding periods, your minimum and maximum return from equities are all over the place because equities are volatile, much more so than they are from, say, cash, which is the light blue bar at the bottom there. But when you come up here, something interesting starts to happen. And what it is basically the bands start to narrow, and the one I'm interested in, the equity one, starts to push out towards the right. And what that's basically telling you is that for any 20-year period since 1899, you could have expected your returns from equity, both minimum and maximum, to beat cash. Say that again, minimum and maximum to beat cash and government IOUs. And that's a fairly spectacular conclusion. Now, the past is no guide to the future. I'm not promising that will happen again. No one can promise that, but it is an interesting observation. Time in the market giving you those long-term equity returns. In summary then, maximise the time you spend in the equity market. Don't panic sell, which is what the headlines will make you do at the moment, and try to avoid forced selling. Now, people do ask me, how do you avoid forced selling? What if you need the money back? It's a good question. Just going to summarise a suggested approach here. You need to get a rainy day fund sorted. Get that redundancy damaged roof fund set to one side. 3 to 6 months of salary should do it. That will need to be in cash or something pretty close to cash. Then look forward, project where you're going to need money back in the future, and plan your asset allocation accordingly. All right. In a nutshell, for short-term obligations, things you're going to have to pay for, you're going to need to be mainly in cash or in something close to cash, perhaps bonds. Beyond that, you can treat your investments as lifetime savings, take a bit more risk, and stick with equities. And 5 to 7 years I've put up there as the length of a typical recent cycle in the UK stock market. So that implies that you need to monitor your portfolio, and as obligations in the future move into that 5 to 7 year range, as they get closer to today, you need to be thinking about how you plan for them, moving down the risk spectrum accordingly. Now, I've summarised a lot of information there. Any questions? To the usual place, please. editor@killik.com.